Good morning, everybody, and welcome to our October edition of our IFRS webinars. And this month, we're looking at more complex tax accounting. You will remember that last month we looked at the basics of income tax accounting, and this month we're taking it up a notch. So welcome and thank you for joining us. As always, I have my fellow IFRS partners with me. The beautiful Ashley there from Perth. Good morning, Ashley.
Good morning, Aletta. Good morning, Kevin. It's good to be back after having a couple of months off.
We're very happy that you're back, Ashley. You've been really busy in all the mining audits there in Perth. Yes. So we're very happy to have you back. Kevin and I have spent all that time in lockdown in Melbourne and Sydney, and we were dreaming of your life. But then you told me you weren't living a life, you were just auditing. So I felt a bit better.
Head down
hello,
for the
Kevin.
last 2 months.
Hello, Aletta. Hello, Ashley. It's good to be back.
All right, thank you. It's wonderful to see you guys. So if we go on to our session, as you know, the trio, we all here. Our agenda last month, it was the basics. This month, complex accounting. So Kevin will be looking at recognition. Ashley will be looking at measurement, presentation, and disclosures. And just a reminder that our November webinar is one of the webinars for the year. And that is an accounting standards update, getting ready for 31 December 2021. So this doesn't mean getting ready for Christmas celebrations or year-end parties, but actually 31 December reporting season. And then in December, we've got our foreign exchange complexities. We've had a lot of questions around foreign exchange, investments in foreign operations, etc. And therefore, we want to spend a bit of time on that. Last month, I've included at the start of the session an impromptu ESG sustainability reporting session and discussion. And we talked about the specific business problem around ESG. That we know that all these financiers, investors, customers, suppliers, everybody's looking for greater transparency. And we've articulated what's the business problem specifically for for-profits and not-for-profits. And then we also talked about, but what is ESG? What is sustainability? And, where do we start? And as part of that, we've listed all these environmental factors, social factors, and governance factors. And I've highlighted in yellow there that one of the governance factors that we've discussed was actually executive compensation. And I know there's always a lot of interest in executive compensation. Ashley would tell me that her listed clients will have a remuneration report that is audited as well. It's that important. And therefore, I thought I would invite today one of our partners in Melbourne, David Young, to talk a little bit about executive compensation and in particular how it links to ESG. So David, welcome and thank you very much for joining us in the financial reporting world. I'll hand over to you to maybe give us a bit of insights around ESG sustainability and how it impacts what you do around executive compensation.
Thanks, Aletta. Thanks for having me. And hopefully, but at the end of this, I actually create more questions and actually answer them. So ESG and executive remuneration is probably not a really new topic because ESG has been around for a long time. Governance has been a big issue in executive remuneration. You've in your intro, Aletta, you spoke of remuneration reports and all that. And in annual reports, some of the things that Australia is doing is actually in some ways ahead of many parts of the world when it comes to ESG. For example, diversity reporting. So gender reporting in terms of number of senior management that are male versus female, etc. That's stuff that's happening in the ASX world. We know that there's a big push in terms of making sure that there are female directors on boards, and I think I can't remember, this year we actually hit where there's probably not a single board in the ASX 200 or close to 0 boards in the ASX 200 where there isn't a female director. So that's been work in progress over the past 10 years, right? So ESG is something that's truly on the mind of listed companies. Now the question is obviously listed companies is not the whole universe in Australia, and I think what I'd like to share here is really some thoughts around what happens in the listed world and how it actually leaks over to the unlisted environment. So the first thing that I'm going to talk about in this short opening is really about regulatory issues, and the second issue is around KPIs and ESG. All right, so let's talk about the first one. To talk about that, we need to actually look at one particular sector to guide us, and that's the financial services sector. We know that since the global financial crisis and then subsequently all the issues that we saw coming out of the Hayne Royal Commission, etc., has put a significant focus on the financial sector. And so the government came up with this regulation called BEAR, Banking Executive Accountability Regime. And that's going to be extended, and that's sitting in front of that's sitting before Parliament right now. It's called a Financial Accountability Regime, and that basically extends what was implemented in BEAR in around 2019 out to the rest of the financial services sector. And it covers all general and life insurance licensees, all private health and insurance licensees, all registered superannuation entities, licensed non-operating holding companies, on top of authorized deposit-taking institutions. And under that regime, basically, there's a requirement that they need to defer variable remuneration of 40% of variable remuneration for 4 years if their variable remuneration is above 50,000. Now, with a lot of executives, we know that their bonuses are going to be high there. The regime also requires policies for clawback of remuneration to be put in place. So companies actually have to show that they have policies for clawback of remuneration when there's fraud or issues and things like that. And then APRA also has additional requirements under CPS 511. That's one of the standards. I'm not going to go into the detail of those standards, but it actually extends more of the deferred remuneration obligation. So the whole idea of deferral in terms of remuneration is to de-risk remuneration, to say that if you've done something good this year, I pay you a bonus, I pay you LTIs, but then a few years down the line, we realize something didn't actually work right, so we're going to take it back. So that's really the de-risking that happens under the regime. But what's important is that it's happening. And why is it important to keep an eye on the developments in the sector? Well, short-term incentive deferral is not new. It's been around since the global financial crisis, and it came about because of this concept of de-risking REM. But if you look across the ASX listed companies, a lot of the large non-financial companies, non-financial sector companies have it. And the reason is because of that whole cross-pollination of board directors across different sectors. So I'm sitting on the board of Westpac. I go to, say Coca-Cola. Actually, I should use ANZ Bank because David Gonski sat on ANZ Bank, and he also was the chair of Coca-Cola. And he says, I think this is a good thing that ANZ is doing. We should think about it here. So that happens, and there's a roll-on effect. I think it's really important because one day, you're going to be asked, how do we actually do this? And as a private sector company, one of the things that you have to think about is obviously, what do you defer remuneration into? In the listed entities, we have equity, so that's shares and things like that, and there's value growth, etc. But in non-listed companies, how do you actually do it? Shares are not easily tradable, etc. So all these different questions are how we help clients actually think through the best structure to put these in place. So that's one.
David,
yeah.
In the interest of time, can we maybe quickly look at the other one I've got? Yes, I've got about a minute. Yeah.
That's fine. The second one's quite easy. It's actually quite a simple thing. And it's around KPIs. And a lot of times companies will say, I want to have an ESG KPI. And the simplest ESG KPI is health and safety. But what we want to say to that is that actually don't just look at one ESG KPIs, it's actually look at the whole suite of KPIs that you have and find how you can incorporate ESG into those targets. For example, if it's top line revenue growth, then we might say, how do we actually drive revenue growth through better sustainable products to our customers? So that's one thing to think about. How do we actually, for example, drive productivity by boosting employee motivation? All right, attracting and talent through greater social awareness, credibility. So things like this is things you need to think about and not just focus on what is the magic ESG KPI. So those are the two thoughts I just wanted to share with you. There is a regulatory lens, it will come. There is also a much more holistic way of looking at KPIs. So hopefully that's been helpful for you. There's a suite of stuff we can do to help clients, and it's about making it holistic and linking together.
Thank you very much, David. If I listen to you, David, I think what you're saying is executive compensation is not just the dollar value, because the world has changed. From an ESG sustainability perspective, we know that the millennials who work here and a lot of our staff and even board directors, it's not just about the dollars. Is they want to work at an organization that's long-term sustainable, that has the right health practices in place, that has the right diversity ratios. It's a bigger picture. So don't just get hung up on the numbers, but let's think broader than that, right? And that's where you guys can help all of them.
Absolutely, that's a great summation.
Thank you very much, David, and thank you very much for your time. I've included David's details if you want to reach out to David to help you to explore this further. That would be fantastic. I know only a little bit, but David, that's really interesting. Thank you very much.
Thanks for having me.
You're welcome. The other thing that that's happened in our practice is I've been starting to speak to partners throughout BDO Australia around ESG sustainability reporting. And as you know, historically, I've talked a lot about financial reporting. We've talked about lease accounting. They say I'm obsessed with BDO lead and lease accounting, which is true. I'll give them that. But in that conversation, I started speaking to Skulk, who's one of our partners in Melbourne again. And the conversation we had, I thought, is really relevant for the attendees of our webinar. And that is, I've said to Skulk, he sat next to me in the office, I said, Skulk, we've got BDO Lead. It does amazing thing. It's a fantastic technology solution. It can do all this net present value calculations. It runs all these reports. We can give clients all their lease journals. And in the same way, around sustainability reporting, we've got a technology solution, and we can do all kind of magic and help clients to do sustainability reports. However, Skulk, and the conversation was, the problem that I've got when I work with clients is that the data that go into BDO Lead and the data that go into our technology solution to do all of these reports is often problematic. I call it dirty data, right? Some might be missing, some might be duplicated, some might be incomplete. It's an absolute dog's breakfast. So the answer that comes out at the end doesn't necessarily look right. It's not because the technology solution was incorrect. It's because there was a problem with the data. Pain. So please share with us maybe some of the things that you see when you work with clients around data.
Aletta, first of all, thank you very much for the opportunity. Absolutely spot on. Look, more often than not, when we talk to our clients about reporting, about ESG reporting specifically, data and data quality specifically is highlighted more often than not as one of the key problematic areas. And there's several reasons for that, and I'll touch on that very briefly. But I think before we sort of get into this, I'd like to just quickly sort of learn from our sort of audience here today, is data quality an issue for them as well? I'd like to, I wonder if we can just very quickly run a quick poll in this regard. So just very quickly there, is it an issue, when you compile your finance, tax and ESG reports?
So Skalk, basically what you and I are saying, please tell us we're not crazy, because we think this is an issue. And we often see this, and we often go in and we take our people with us to try and clean up the mess. But, you know, maybe we're looking for a bit of validation, yes, Skalk, that we're not crazy.
Yeah. Yeah, absolutely, Aletta. And look, I mean, it is something that can be solved. I mean, at BDO, you know, we've actually got several capabilities that help our clients work through some of these sort of challenges. I mean, but over and above the quality aspect, I guess sort of the second component or aspect that we often hear from our clients that is really problematic when they do ESG reporting is the lack of or the level of automation. So, you know, more often than not, I'm hearing clients say to me, Skalk, you know, when we do these reports, it's a time-consuming exercise. It's a painful exercise. The quality is not good, but I have to intervene. A lot of the cases, the process is not streamlined, you know, and then, you know, more often than not, I need to download the data into a specific staging environment or into a spreadsheet of some sort. And then there's a lot of manual interaction and involvement as we process this data set, you know, ultimately before we can upload it into a tool or into, you know, an environment such as BDO Lead. So I think, you know, just as a second polling question, I'd like to just quickly understand from our audience again, you know, do they experience the same thing? You know, to what extent do you need to intervene manually and actually, you know, prepare the data set before you can actually do your ESG reporting or tax or finance reporting for that for that purpose? Just a quick question there.
And
then
Skalk,
yes.
again, this to me is an interesting question. Because, you know, for lease accounting, for example, with BDO Lead, we've got a great level of automation. However, we have to extract the lease data from lease agreements. And, you know, you have to go back and get the basic terms and conditions out of these agreements, but then you also have to speak to management about what are their views around lease term, and all of that is manual. So a lot of manual interaction. And the other thing is getting data from different systems, Skalk. It does my head in. You know, there's no system with everything in it. We are scratching around getting data from everywhere to put it into BDO Lead, yet another system, to run the processes. So a good question, Skalk. Let's see what people think about this one.
Oh, so Aletta, this absolutely matches with what we're seeing, you know, across our broader client range, is that, you know, it's really problematic for our clients to just generate reports. So I think, look, just in the sort of the interest of time, look, the good news is there are sort of solutions out there to help. I often hear clients ask me, you know, where do we start? The problem seems so big. We've got such a lot of data. More often than not, I advise my clients, let's start by doing just an initial assessment. So let's do an assessment of what the scenario looks like. What does your architecture look like? Where does the problem come from? And, you know, once we've done that initial assessment, then that gives us a plan of attack or structured plan of attack that you know, we can then address. And there's multiple possible ways of addressing it. It often starts, you know, as high up as looking at the data strategy that the client has. How do they look and see at data? You know, what governance structures do they have in place, and what controls are in place to ensure that the quality of the data that's underlying or underpinning that reporting capability, you know, how that is actually derived. So there's a lot that can be done to alleviate this. Our clients really don't need to be struggling with this. And I think, you know, in closing, if they would like to talk to us a little bit more, Aletta, you've put the slide up there. There's our contact details. There's I'm part of a larger team within BDO that focus on data specifically and help our clients through data. So we've got several sort of stakeholders, but your sort of attendees should feel free to reach out, and we'd be more than happy to explore this further or discuss this further.
So, Skalk, when we talked about this, I think the answer is we can go and help with a particular data problem and try and solve a particular data problem at a point in time. But obviously, it is better to consider what causes this data problem. Because if there's a data problem around lease accounting, potentially there's a data problem further throughout the organization that would require a bigger rethink on how we deal with data, hence the word, the data strategy, right?
Yeah, absolutely, Aletta. And I mean, that's often the starting point because, when you look at data, we need to understand where the organization is going with data and how it sees data and where it's going to store data and what it wants to do with data and how important that is in achieving its strategic objectives. So absolutely spot on. But as I said, typically, a good place to start just to get around the problem is to do an initial assessment, which then sort of helps you structure almost your plan of attack as to how you're going to approach that. So I hope this is helpful to most of the attendees today. And as I said, happy to discuss this in more details. There's our contact details, and feel free to reach out, after the webinar.
Thank you very much, Skalk. Is that invitation also directed at fellow partners at BDO who have data in? Thank you very much, Skalk.
Absolutely, we're all happy to, and thank you for the opportunity.
All right, Skalk, you take care. So Kevin and Ashley, I think you've also experienced all these data issues at your clients. Kevin, I know you've also done some big projects where we've helped clients with data. But after all of that fun and games, we're back to income tax, IAS 12 or AASB 1112. Kevin, I'll hand over to you. You want to do a recap from last month, and then we'll move on to some more problematic parts.
Thanks, Aletta, for that. And yes, data. And I fear that data can even extend, I guess, to the data that feeds into, shall we call it, deferred tax and tax accounting calculations. It's really pervasive throughout everything. So there's certainly a linear connection there. But I'll just jump into the revision from last month. So look, most of what we dealt with last time was the tax effects of transactions, and really this distinction between current and deferred tax. Interestingly, got a couple of feedbacks from last week's session where a lot of people actually said, wow, the basic information that I guess I often think is just sort of the standard knowledge across the industry was actually pretty good for a lot of entities. One or two guys actually commented that they didn't actually know what deferred tax was. They just had it on their financials every year because the auditor said that it had to be there. So it was actually a good topic to choose. So I thought I'd go back and actually refer to some of these again, just to recap some of the definitions. Current tax, really just your taxes payable based on your taxable income with a tax rate applied to it in the current period or the period under review. And deferred tax, really on the other side of the reporting date, are taxes payable or recoverable in respect of future periods. What's really important is with the deferred tax, it's really what's going to arise in terms of taxes payable in respect of future periods or recoverable when the assets are recovered or the liabilities are settled. So it's all about balance sheet, balance sheet, balance sheet. Jumping on to the next slide, just from the recap then, Aletta. So the current tax, and I think Aletta did this section last time where we spoke about really current tax is your calculation, taxable income times your tax rate, gives you a current tax payable or recoverable. And Aletta did actually deal with journal entries there being debit income tax expense, credit current tax liability. And I don't think anybody has a real issue with that. That's pretty basic. We did that last time. And I think everybody's happy with the concept that in the current period, your profit, your accounting profit will be give rise to some sort of taxable income calculation, add back certain items not deductible, deduct things that are not taxable, and you'll get to a current tax payable. What we didn't deal with last time, which is what we're going to do today, is on our next slide, which is how the deferred tax works. Now, we did deal with the calculation, which is a balance sheet approach to deferred tax, where we take the carrying amount of assets, compare it to their tax bases, and the same with the liabilities, and compare it to the tax bases. If there's a temporary difference, that temporary difference times the tax rate gives us deferred tax. And the easiest example I always say is, you've got an asset like property, plant, and equipment, let's say of $100, and there's no future tax deductions allowable on those assets. The $100 represents, shall we call it, future economic benefits or taxable income. No deduction against it for a tax base of 0 will give you a $100 temporary difference, and that is a taxable temporary difference. It's deferred tax liability. Implicitly, what's built up in that is the concept that as that asset is used and those income, the income is generated from the asset, let's say to the value of the 100, with no tax deductions in a tax base allowed against it, you're going to pay tax on that in the future, and that's the concept of deferred tax. Taxable temporary differences, future tax when the assets are recovered or the liabilities are paid. What we didn't do last time is the debit. Where does the debit go? Now, I've put on this slide as part of our recap question mark, question mark, question mark. And the reason for that is because there is a thought process. A lot of people will say, well, that goes straight to the income tax payable. That's not always true. So we're going to deal with that today. And on the next slide, Aletta, when you jump through, we'll have deductible temporary differences. Same formula. This is just when you recover the assets or the liabilities in future, what's actually going to happen is you're going to have a net deduction in your taxable income in the future. That's a recovery or deductible temporary differences. Those are deferred tax assets because there'll be less tax in the future when the assets and liabilities are recovered. And the same thing here, where does the credit go? There's a knee-jerk reaction to take that to the income statement because that's where everybody thinks it goes. And that is where it goes often because, let's face it, the differences that arise in tax between current and deferred is often as a result of a difference between accounting profit and taxable profit. So that's an income tax charge normally to profit and loss, but not always. And so we're going to deal with that today in the carry forward of our topic. This was a nice little template that Aletta had in the slide deck last week, and we do use this often in some form of Excel version where we deal with calculations for clients. And it's really just a visual representation of deferred taxes, listing all the assets and liabilities down the left-hand column, their carrying amounts, comparing it to a tax base. And the reason why I put question marks in there is, if you remember last time we spoke about the tax base being very much tax driven. So dealing with income tax specialists, people with tax specialism knowledge, because it's not all accounting driven. The tax base is very much what is the tax base for tax purposes? So you might need to go engage with your tax specialists, and then you're going to get taxable and temporary difference and deductible temporary differences in there. Now, the temporary differences directly in equity, we didn't really deal with that last time. We're going to deal with that today, but some of these go to equity, and I'll take you through how we get to those in a moment. This is a template you can use. These two slides I won't be dealing with much today, but it's just a recap of how do we work the tax bases of the assets and liabilities out. And there really were two rules for tax bases of assets. And on the next slide, there were two rules for the tax bases of liabilities. I will not be repeating those today, but they were a key part of last week's session. So, sorry, last month's session. So if you missed last month's session, and you want to learn more about how to determine the tax bases of the assets and liabilities, please refer to the recorded session on our website. You can go and have a listen to that and work through that. What we're going to do today, jumping straight into it, is recognition and measurements on a more complex basis. So I'm going to deal with recognition concepts first. I'm going to run through this. Now, what we mean by recognition is recording the entry, putting it into your trial balance or into your financial statement. So that's why we're going to deal with those question marks in the recap about where does the other side of the entry go. You recognize deferred tax and current tax. Where does the other side of the entry go? So accounting for current deferred tax of transactions must be consistent with the accounting for the transaction or event itself. Now, we've put the paragraph reference number from the standard AASB 12 in there. Now, when you read that sentence, it probably makes no sense to anybody. If you read the deferred tax standard, I have to say, Ashley, you can maybe agree with me on this one, but if you actually read the standard, I actually realized the standard makes no sense by itself. You almost need years of training to understand what they're on about. And I realized that if I hadn't been trained at university on deferred tax, I probably couldn't have figured the income tax standard out by myself, because taxable temporary differences and deduct, all these words, they're literally very unique to the standard. So you kind of have to figure it out. What is this sentence trying to tell us? Well, actually what it's trying to tell us is when you recognize current and deferred tax, what actually happens is the related transaction will tell you where to put the other side of the entry. That's the layman's interpretation of what's going on here. And I'll show you what I mean as we move forward. So that's the basic concept of recognition, but it also basically means that, or tells you that when you recognize it, where do you take it and how do you present it? Later on the next slide, then we'll jump into this. And Letter's driving the slides today, so I'm waiting for it to update. Okay, so transaction and events recognized in profit and loss. So the basic concepts in the recognition of deferred tax in particular and current tax is to take it through to profit and loss. So most of you, when we looked at those entries, when I did the recap, you would tell me that if I'm recognizing current tax, I'm going to take it to an income tax expense. That's correct. If I recognize deferred tax, I'm going to take it to profit and loss as an income tax expense, whether it be a credit or a debit. And that's coming from the very first bullet point on the slide, because that is the, shall I say it, the default position. But the exceptions is actually what establishes this rule, which actually is an interpretation of the previous slide, which basically says that for certain transactions, you actually need to take the other side of the entry in the deferred tax recognition to equity if the related transaction is going to equity. And the same with business combinations. There's an exception there, which basically says you don't take it to profit and loss, but you take it to goodwill, or often to a reserve that's associated with the business combination accounting, because for the business combination accounting, there's a standard that tells you how to account for those, AASB 3, and normally what actually happens there, you've got goodwill or negative goodwill being recognized, so you're really following the transaction. So in other words, and I've written this at the bottom of the slide, and I'll show you a couple of examples soon, the deferred tax entry follows the transaction. Now, the red at the bottom with an underline is very much my language. I kind of took some liberties here. It's my way of understanding how it works. So I'm dumbing it down a little bit, because all the language above, which is all from the standard, is all relevant, but the way I understand it, and has always kind of trained myself, is to follow the transaction, which basically means wherever the related transaction went, whether it be to profit and loss or equity, or let's say into a business combination transaction like goodwill, the deferred tax, when you recognize it, the other side of the entry kind of follows the transaction. That's really what I mean by that. In other words, if you've got an entry that is a transaction that affects profit and loss, the related deferred tax is going to follow you to profit and loss as well. If you've got an entry that's going to, let's say, a revaluation reserve in equity, the deferred tax is probably going to follow you there. And that's what I mean. So please, that comment at the bottom about following the transaction, very much a layman's term. It's very much my language there, which kind of tells me how to do this, because I'm trying to instill in you a concept here, and that's the best way I can do it, because I'm not very clever when it comes to big words in the deferred tax standard. I let her put this together in a previous presentation that she's done, and I quite liked it, so I've dragged it into my section here as well, which is just the decision tree. And Aletta will tell you she loves decision trees. I like words, Aletta likes decision trees, and so we always try and put them both in. So basically a very simple one is, if it's not going to profit and loss as a default, and the item that it relates to is charged directly to equity, the current and deferred tax is going to go with it to equity. And that's what I mean by it follows the transaction. Otherwise, it's going to go to profit and loss. And there's an exception to this as well, sometimes in business combination accounting, which I've got a few examples in here as well, which we'll talk about later. So items credited or debited to equity. This is from AASB 101. Not all of the examples are in here. There's a couple ones that I'm missing in here, but the general ones that affect the transactions that affect equity directly or go directly to other comprehensive income are these. These are the general ones, and the most obvious one is revaluations of property, plant, and equipment. And I mean, I think when you do accounting for the first time at university, and that, you know, accounting for property, plant, equipment at cost less depreciation is one of the first accounting concepts you learn. And you also learn that that for property, plant, equipment, you can choose the accounting policy to revalue items of PP&E or categories of PP&E. When you do that, it's a debit to the asset and a credit to a revaluation reserve, which is straight to equity. Well, when you do that, you increase the asset base or the asset carrying amount of the asset. So what you're doing is you're increasing the deferred tax, because in our little calculation where you've got deferred tax carrying amounts versus the tax base, when you revalue items of PP&E directly to equity, you're going to go debit asset, credit revaluation reserve. That debit to asset increases the carrying amount, which means it increases the temporary difference and increases the deferred tax liability. So you're going to have more deferred tax liability created. And the journal entry to increase deferred tax liability is debit something, credit deferred tax liability. Well, that debit to something is going to go directly to equity, because the related revaluation entry also went directly to equity. And that's what I mean by it follows the transaction. A couple of other examples in there, things like exchange differences on foreign exchange, compound instruments, and so forth. But following on from the example I did, which is on the next slide, Aletta, and you were perfectly valid to move to the next slide, which is actually showing what I mean by follow the entry. I'm carrying on with my example of following the transaction here with property, plant, and equipment. And if you're under the standard which revalues property, plant, and equipment directly to equity, there is another standard which is investment property, and that one doesn't revalue property directly to equity. This one takes it through to profit and loss. So I've put this one in here to show you what I mean by follow the transaction. If you're revaluing property, but the property is actually investment property, those of you will know that investment property carried at fair value under AASB 140 is revalued directly to profit and loss. It's a gain to profit and loss directly. So in this case, if the related deferred tax is created, the debit being the debit to the deferred tax liability as a result of revaluations will go straight to the income statement also, because it follows the revaluation to profit and loss. But on the next slide, if I had to take the same property and put it into property, plant, and equipment revaluation, then I'm going to actually have my debit to an equity revaluation reserve. You can see that there on the slide. When I create the deferred tax liability, that debit is following the related revaluation directly to equity. And that's what I mean by follow the transaction. It's almost like follow the money. If you follow the money, you know where the entry is going. So that's really the easy concepts on what we mean by follow the transaction. So of course, in everything in accounting, there are exceptions. So now I'm going to take you through some of those exceptions in terms of recognition. Letty, you can move on to the next slide here, if you may. So we're still with recognition. Basic concepts is every deferred tax liability, and the truth must be said, with assets is recognized when you've got taxable temporary differences for liabilities and deductible temporary differences for assets. You must recognize that. In other words, what it's telling you is you have to record a journal entry, debit or credit, deferred tax liability or asset, depending on which way you go, depending on what you have, and the other side must follow the related transaction. There are 3 exceptions to the general rule, and I'm going to take you through those now, and these are our complex side today. The reason why these exceptions are there, and I'm going to be honest, there's probably those who don't like the way I'm going to put this, but when it got hard in the accounting standard and they didn't know what to do with the other side of the entry, they made an exception. So these exceptions are largely driven by it got tough, they didn't know how to follow the transaction, so just created an exception. It is actually true. It's not the way the standard is written, but if you follow the creation of the deferred tax standard or the income tax standard from years ago, and I'm talking 20 years ago, and Aletta and Ashley, I'll kind of give away my age now, but back in the day, we used to do this thing called timing differences and an income statement approach to deferred tax. It was because the other side of the entry had nowhere to go, because the follow the transaction got lost, and some of those rules have kind of made their way still into the standard. And this is the first one, the recognition of goodwill. And if you think about it, and I'm talking about deferred tax liabilities now, when you recognize goodwill, you are going debit goodwill. That's an asset, which probably doesn't have a tax base. So you've got a temporary taxable difference between the two, a goodwill number with no tax base. The rules when you do the calculation of deferred tax will tell you you've got a deferred tax liability on that. And the deferred tax liability is credit liability, where do you take the debit to? And the debit would go to goodwill, because as I said, the rules will follow the transaction is you follow the related transaction for the other side of the deferred tax entry. The problem with doing that is, and I think you can jump to the next slide because this is where the detail is on. If you credit deferred tax liability for a goodwill taxable temporary difference, what's going to happen is you're going to keep debiting goodwill. But if you debit goodwill again, then it's going to create more deferred tax temporary difference, which means more deferred tax liability, which means more debit to the goodwill. And then there's just endless permutations of creating deferred tax from more goodwill. Every time you debit the goodwill with more deferred tax, it just goes loops around. And so the solution to that is don't recognize any deferred tax on the goodwill temporary difference, because otherwise there's an endless permutations of debits and credits and debits and credits. And now you can see why I said when they wrote the standard, when the going got tough, they just stopped because it was too hard to solve. And so the way they did that was no deferred tax on goodwill, no deferred tax liabilities on goodwill, because the other side of the entry just creates an endless permutations of more debits to goodwill. So that's your first exception. Second exception then is okay. Now I have to say I hate this slide. And when I put this together last night, I did take some material that Aletta has used previously in our tax workshops, virtual workshops that video has online. And I noticed that Aletta also struggles with this one, and so both of us have the same approach to this exception. First of all, the exception, the way the accounting standard writes it, and on the next slide, don't go there yet, Aletta, but on the next slide, it's going to be the English language way to interpret what this slide is trying to say. The exception to the recognition of deferred tax assets and liabilities is really if the initial recognition of the asset gives rise to a transaction which is not a business combination, and at the time of the transaction affects neither accounting profit nor taxable profit, you don't recognize the deferred tax. Now, what does that even mean? Both Aletta and I have in our previous workshops, we've tried to interpret that, and that's on the next slide. We've tried to make it more English. The problem with the next slide is that there's more words here. So let's work through it really quickly. Worded another way, what the previous slide is trying to say is that your taxable, or in some cases deductible temporary differences, must be recognized as deferred taxes when they arise in a transaction that is a business combination, or at the time of the transaction affects current tax or accounting profit. So I've actually just tried to make this positive as opposed to a negative statement. But basically, what's written in the IE, in other words, for both of these, and I'll take you through it, is the complex part. If you've got a business combination and you've got assets and liabilities that are giving rise to more deferred tax, either assets or liabilities, as part of that business combination, it's going to create deferred tax liabilities or assets. You must recognize that deferred tax with an entry to normally goodwill, because there's somewhere to take the debit and you're going to take it to goodwill. But remember, once you debit it with debit goodwill, there's no additional deferred tax on the goodwill, but you must recognize the deferred tax on the related transactions in the business combination, because there is a place to take the debit, and that is to goodwill. Or if it's not in a business combination, you should not recognize deferred tax if you've got nowhere to take the follow-on transaction. In other words, if the transaction affects current tax and accounting profit, there's normally always somewhere to take the debit or take the credit, because it can follow the transaction. But if it doesn't affect current tax or accounting profit on initial recognition, there's nowhere to take the related entry to. And the only way to tell you what I mean by this slide is a couple of examples, because this is not complex to understand, but it's kind of trying to create a rule that follows this concept, which is crediting and debiting things to equity. So let's just do some examples, and I'll show you what I mean. Now, these are the more complicated examples today, and we've already given you the answer at the bottom. There's going to be no polls on this. This is something you can take away and work through yourself. There's 3 examples, and basically all of these are trying to show you the concept that if there's a place to take the follow-on transaction to when you create deferred tax, which can follow the related transaction, then off you go. You recognize the deferred tax, but if you can't do that, don't recognize the deferred tax. So this one is interest received in cash on the 30th of June 2020, which happens to be the last day of the 2020 financial year. So we've received it in advance of the 2021 financial year. but it's taxed on a cash receipts basis. So what's going to happen in your entries? You're going to go debit cash, credit interest received in advance of $1,000, and what's going to follow on from that is you're going to have a current tax entry of $300 in the 2020 year, because you're going to have to pay tax in the year when the cash was received, which is on the last day of the 2020 year. In this scenario, what's going to happen next year, in the following year, is that there's going to be a deferred tax asset, because what's going to happen is you'll pay less tax next year, even though your accounting profit will have that interest in accounting profit in the subsequent year when the income in advance becomes accounting profit. In this scenario, because we've got an entry that's moving through profit and loss, the one in green, what's going to happen is you've got somewhere to take the deferred tax related entry to, because it's following the transaction to profit or loss. Put another way is, because there's an impact on accounting profit, on taxable profit, being the entry of $300 being your current tax liability, that is affecting accounting profit in the year that you've received the cash. There is a place to follow on the entry for deferred tax to the same place, which is to income tax in profit and loss. It follows the transaction. On the next slide, you'll see what I'm on about when you'll suddenly see an example where there's no current tax and initial recognition. So yeah, I'm going to say you've got a BMW company car purchased on the 1st of January 2020, different example, for $100,000. It's not part of a business combination, and in this case, we're going to make up some little rules and say that this one has a tax base of $60,000. Where the future deductions on the motor vehicle, on the company car, are only going to be $60,000. For whatever reason, $40,000 of it will not be deductible in future. So it's a limited amount of deductions available on this car. And you can see right off the bat that you've got a deferred tax difference arising on the very first day of the transaction, on what we call initial recognition, because you've got an asset of worth of 100, but a tax base future deductions of 60. So there's a $40,000 temporary difference there, which arises on the very first day of recognizing this transaction. And that difference must be recognized as deferred tax. You would normally go credit deferred tax liability, being the 40,000 times the tax rate. The problem is that this entry did not affect accounting or taxable profit on the very first day. We went debit motor vehicles, $100,000, credit cash of $100,000. That's the first entry, but there was no current tax entry on that day, because we're not entitled to any of the deductions on the very first day, for example. But there's also no accounting impact on that day. So we've got nothing gained to profit or loss. We've got nothing gained to equity, and we've got nothing gained to goodwill. It's all gained to the motor vehicle. So if we had to recognize deferred tax, being credit deferred tax liability of $12,000 on the first day on initial recognition, there's nowhere to take that debit to. The only place you can take that debit to, if it follows the transaction, is actually to the motor vehicle account. And you can't debit motor vehicles for another $12,000, because then you're going to have motor vehicles recorded in your book for $112,000, but you only bought it for $100,000. In other words, you're going to have immediate impairment on the motor vehicle. So you can't capitalize this deferred tax liability to the motor vehicles where the original transaction happened, because that by itself is an asset. Didn't go to profit, didn't go to equity, didn't go to goodwill. There's none of that on the screen. So this is one of those exemptions, because it doesn't impact current or taxable profit on the very first day on initial recognition. It's exempt from recognition on deferred tax, because there's really nowhere to take the debit to on the deferred tax. And that's what we mean by the initial recognition exemption. That doesn't mean there's never going to be deferred tax on this. I think a couple of slides later, I'll make this point that when you start to depreciate the motor vehicle, there will be some new temporary differences arising from depreciation, because this entry will affect taxable profit and accounting profit from day 2 when we start to amortize and depreciate it, in which case those temporary differences will get recognized, because they will get recognized on the basis that there is an impact to accounting profit or taxable profit on those days. And so there is an opportunity for the deferred tax to follow the transaction to profit and loss, and that's when you will recognize those. Now that's a lot to take in, and I will let that settle. If you have any questions on that, I'm happy to take them offline, and you can kind of work through them with me if you want to give me a call, because it's not an easy concept to grasp. I'll jump a couple of slides in the interest of time to the third example, which I have in there. That one there, so further example number 3. Sorry, just back one later. So this one I actually created. It's not a great example on the motor vehicles. Sorry, Aletta, just one on. There we go. Bit of a timing delay. So in this case, I've taken the same example as before, but I've actually said that this one is part of a business combination. I actually had this conversation the other day with some of our tax guys, because this is starting to be a real life example with the instant asset write-off. We are actually starting to find that with vehicles and other purchases, and when there's a business combination, there is actually a difference in some cases on these types of acquisitions. You'll often see this in a business combination with, for example, customer lists, where you have a customer list which wasn't recognized, for example, in the acquiree in a business combination, but suddenly when you apply the business combination accounting under AASB 3, you've got a new asset, like in this case it's a motor vehicle, but often it's customer lists, where you suddenly recognizing these things that weren't there before. In this scenario, it's essentially the same example as before, but you can see in this case I've taken it to goodwill, because in my mind, because it's a part of a business combination, it can actually go somewhere, and that is it can actually increase the value of the goodwill. In other words, it follows the business combination transaction, and therefore the exemption doesn't apply. It can go somewhere. The deferred tax liability on this particular asset, if it was part of a combination, has somewhere to go, and that's following the business combination entry to goodwill. So there's just an example of, once again, demonstrating if it can follow the transaction, it can go somewhere. Okay, last exception, because I want to hand over to Ashley and let her get some of the measurement concepts dealt with. There is an exception on investments in subsidiaries, branches, associates, and joint ventures, where if the following conditions are satisfied, there is an exception to the recognition of deferred tax liabilities, and there's a similar rule on the deferred tax asset side, that the parent, investor, or venture is able to control the timing of the reversal of the temporary differences, and it is probable that the temporary differences will not be reversed in the foreseeable future. So in other words, there's a bit of judgment calling going on here, which basically is, if the judgment is that we can control essentially the reversal of those temporary differences, being the controlling party or the investor, and it is probable that they will not be reversed in the foreseeable future, you won't be recognizing deferred tax liabilities on that. The next couple of slides essentially take this concept and do it in the other way, because as you know, with deferred tax assets being unused tax losses and credits, it's a similar rule, just the other way around, where you've got deductible temporary differences in the future, but that to the extent it is not probable that there'll be future taxable profits against which to use it, you probably wouldn't actually recognize those either. So the general rule is, obviously you do recognize deferred tax assets on all deductible temporary differences, but the exception is, which I think is on the next slide, if there aren't any future taxable profits against which you will use that, the temporary differences will reverse in the future, and the taxable profits aren't available against which to actually utilize those, then you won't recognize taxes to that extent. So a couple of slides to get there. A little bit rushed perhaps towards the end, because I want to hand over to Ashley to do measurement, but have a go at those 3 examples I had a look at and to try and see the exceptions to the recognition principles. Not always easy to apply in practice, and obviously there's many variations to that. Ashley, with that, I'll hand over to you.
Thanks, Kevin. Massive effort. The recognition rules I find very complex, but you did it in a way that actually makes sense to me. So hopefully everyone else was following along just as attentively. Okay, so for me, fortunately, the measurement principles, which I will go through now, are not as complex. So firstly, looking at current tax liabilities and assets, and the requirement is that the current tax balances shall be measured at the amount expected to be paid to or recovered from the taxation authorities, using the tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. So fairly straightforward. You just need to make sure the correct tax rate is being applied. Looking at deferred tax liabilities and deferred tax assets, So this is slightly more complex, but the key principle is that the measurement of deferred tax balances shall reflect the tax consequences that would follow from a manner in which the entity expects to recover or settle the carrying amount of its assets and liabilities. So again, we come back to the concept of tax consequences and understanding what's going to arise in the future. Looking at the manner in which the entity recovers the carrying amount of an asset or settles the liability, sorry, I led it back one slide. I just quickly touch on the expected recovery. So management's intentions can affect either both the tax rate applicable, so meaning that you must calculate your DTL or DTA using the rate that is expected to apply in the period when the asset is realised or the liability is settled. And the manner of settlement can also impact the tax base of the asset or the liability. So for example, there may be different tax consequences if you intend to sell an asset rather than recovering its carrying amount through continued use. So where the manner of settlement affects the tax rate and the tax base, the entity measures deferred tax liabilities and assets using the tax rate and tax base that are consistent with the expected manner of recovery or settlement. So moving on, another measurement point in AASB 112 is that you are not allowed to discount deferred tax assets and deferred tax liabilities. So the standard says that a reliable determination of the discounted amount can be highly complex, especially seeing as temporary differences are based on carrying amounts that may already be discounted. So again, following on from Kevin's earlier comments, reading the standard, it seems that this fell in the too hard basket. So they've put a rule in to say that you not only can you it doesn't require discounting, but it specifically prohibits this. And then also just touching on the deferred tax assets specifically, one of the exceptions that Kevin just went through is that for deferred tax assets, the carrying amount must be reviewed at the end of each reporting period. So it's important to realise that this applies to all DTAs. Some people think this is only relevant for DTAs recognised in relation to tax losses, but that's not correct. The recoverability assessment must be applied equally to temporary differences as well as unused tax losses or credits. So if a DTA has been recognised initially following the recognition rules that Kevin went through, but now at period end, it's no longer probable that sufficient taxable profit will be available, then the carrying amount must be reduced to the amount that is considered recoverable. And then going forward, any such reduction shall then be reversed to the extent that it subsequently becomes probable. So they're the main principles behind measurement of DTAs and DTLs. If there are changes to these carrying amounts, so these can arise, for example, if there's been a change in tax rates, which we have recently seen in Australia for certain entities, if there's been a reassessment of the recoverability of the deferred tax assets, as I just went through, or if there's been a change in the expected manner of recovery of an asset. So back to the example where the deferred tax balance was calculated, for example, if you on the basis of expected sale of an asset, and now that expectation has changed to one where you'll now be using the asset, this can change the carrying amount of the related deferred tax balance. So these changes in the carrying amounts of the deferred taxes follow the same principles as on initial recognition. So if it arises from items that were recognised in profit or loss, then the change is taken through profit or loss. But if the change arises from items that are recognised in other comprehensive income, then the changes is recognised directly in equity. So again, same basic principle as initial recognition, the change must follow the transaction. looking at presentation, here we're talking about presentation in the balance sheet and whether the tax balances can be offset or if they're required to be disclosed separately. In regards to current tax balances first, the standard states that the entity shall offset, so not that they can or may, but that they shall offset, but only if there is a legally enforceable right to offset the amounts and the entity intends to either settle on a net basis or to realise the asset and settle the liabilities simultaneously. So the standard requires current tax balances must be offset, but only if these conditions are met. A legally enforceable right to set off current tax asset against a current tax liability generally exists when the current tax balances relate to income taxes levied by the same taxation authority and the tax authority permits the entity to make or receive a single net payment. Moving on to the deferred tax balances. And again, the standard requires that the entity shall offset assets and liabilities, but then again, only if certain conditions are met. So for deferred tax balances, there must be a legally enforceable right to set off current tax assets against current tax liabilities. And also, if we're looking at one taxable entity, the deferred tax assets and deferred tax liabilities must relate to income taxes levied by the same taxation authority, or if there are different taxable entities, the deferred tax assets and deferred tax liabilities must relate to the same taxation authority, and also the entity must intend to settle current tax liabilities and assets on a net basis. And that test needs to be satisfied for each future period. So generally, the circumstances giving rise to set off between entities in a consolidated entity are likely to be rare unless those entities are part of a tax consolidation group. And then the final section today, disclosure requirements from AASB 112. So firstly, the major components of tax expense shall be disclosed separately, and yeah, as shown on this slide. So these may include current tax expense, any adjustments recognised in the period for current tax of prior periods, the amount of deferred tax expense or income relating to the origination and reversal of temporary differences or amounts relating to changes in tax rates or the imposition of new taxes, the amount of the benefit arising from a previously unrecognised tax loss, and deferred tax expense arising from the write-down or reversal of previous write-down of a deferred tax asset. So essentially, anything that impacts your current or deferred tax expense must be disclosed. Additional disclosures also found within AASB 112. These are in paragraph 81, and the key ones include the aggregate current deferred tax relating to items that are charged or credited directly to equity, a reconciliation of the relationship between tax expense and accounting profit using either numerical reconciliation between the dollar value of the tax expense and the accounting profit, or the reconciliation can be based on using the average effective tax rate and the applicable tax rate. Also, one of the disclosures that often gets missed is the requirement to disclose the amount of deductible temporary differences, unused tax losses, and unused tax credits for which no deferred tax asset is recognised. And finally, if there's any significant judgments made in relation to the recognition of a DTA, so for example, in situations where an entity has suffered a loss in the current or preceding period and a DTA has been recognised in excess of any DTL, an entity shall disclose the nature of the evidence supporting recognition of the DTA. So they were the main disclosure requirements of the standard. And that concludes our two-part topic on tax accounting. Aletta or Kevin, any comments, or shall I hand back to you, Aletta, to wrap up?
Yeah, thank you very much, Ashley. And Kevin and Ashley, you've done a great job to look at some really complex stuff. Those recognition exemptions are weird and wonderful, or maybe weird and not so wonderful, but also around measurement, some tricky stuff. So thank you very much for that. I would like to say thank you very much for everybody that's attended our webinar. Remember, next month is the big one, getting ready for 31 December 2021 reporting. And then just finally, if you're looking for any assistance around any of the matters that we've discussed today, so it could be that you're starting to think about getting ready for general purpose financial statements. It could be that you're getting ready for an IPO and you want to look at whether you are ready from an IFRS perspective. It could be you need training, virtual workshops around the new accounting standards. Please contact us. Our accounting news will be going out tomorrow. I've recorded a video for it this morning and I'm reviewing articles. It's got 11 articles in it. It's jam-packed with great stuff, all the latest developments around bed licenses, disclosure of JobKeeper payments, etc. So please look out for the newsletter tomorrow. And then just our leaders, our IFRS advisory leaders, please feel free to contact us around any IFRS or sustainability matters. And then also just a reference to our team. I would like to say thank you very much. Have a great day, and we hope to speak to you next month.
Thanks, bye.